When a person dies, then a tax assessment has to be done for the period from 1st of March until the date in the tax year when the person died. Any of the person's assets that may attract capital gains tax may have to be entered into Wintax's CGT calculator as a disposal. The market value on the day before the date of death is to be used as the selling price in the calculation. If we say that a taxpayer died on the 7th of July, leaving behind his primary residence, then there could be two possible scenarios. Let's call them Scenario A and Scenario B. Scenario A. If the taxpayer specifically bequeathed the asset to his surviving spouse, then there is no capital gains tax associated with the transfer of the primary residence to the surviving spouse and this transaction. The primary residence merely passes to the surviving spouse, and capital gains tax will only be levied when or if the surviving spouse disposes of the asset or when the surviving spouse dies. It is important to remember that when this asset passes to the surviving spouse, then the surviving spouse acquires this asset at the rollover base cost, which is the original purchase price that this primary residence was originally acquired. Also note that in a case like this, the primary residence will not be liable for estate duty. Scenario B. If, however, the asset was not specifically bequeathed to the surviving spouse, then the primary residence is liable for capital gains tax in the hands of the deceased taxpayer's assessment for the period of the tax year up until death. In a case like this, you must enter the transaction into the CGT calculator in Wintax. The market value of the asset on the day before the date of death must be used as the selling price in any time-apportioned base cost calculation. Wintax 2017 will grant an annual exclusion of 300,000 Rand on the gain and add 40% of the balance to the deceased estate's income for tax at normal rates. The estate will acquire the asset at the market value of the asset on the date of death. Let's have a look at an example where the deceased's tax assessment is saddled with a CGT transaction on a primary residence. Now this is the capital gains tax calculator in Wintax 2017. Don't forget what we've done on the personal details screen is we've put in the facts that Mr. Bloggs died in the tax year, and we put in his date of death. Now looking at the capital gains tax calculator in Wintax 2017, we can see the asset designated as a primary residence, which means the profit of 6 million is reduced by the 2 million Rand primary residence exclusion to 4 million Rand. Don't forget, if this asset was acquired before 1st of October 2001 and we never had it valued on 1st of October 2001 and we ask Wintax to calculate a deemed base cost on 1st of October 2001, then we need to enter the date of sale as the day before the taxpayer died. This is important as one day can make a huge difference in the time-apportioned base cost calculation, but Wintax will do all this correctly for you. If we remove the screen and look behind it, we will see the 6 million Rand profit SARS wants to see on the ITR 12 as code 4250. SARS will apply the 2 million Rand primary residence exclusion to the 6 million Rand to give us the 4 million amount that goes towards CGT. Like SARS, Wintax 2017 will deduct the 300,000 Rand annual exclusion in the year of death from the 4 million and apply 40% to the balance to give us the amount of 1,480,000 that is going to be added to Joe Bloggs' income for normal tax. If we assume that Bloggs' tax rate is 36%, then the tax due on this transaction will be 36% of 1,480,000, which is 532,800 Rand. Looking at the estate duty estimator in Wintax 2017, we can see the value of the property in the estate is the 8 million rand value less the 532,800 tax liability, and the estate duty due is 793,440 rand. The 532,800 plus the estate duty of 793,440 need to be paid, and this comes to 1,326,240 rand. Unless the estate has this amount of 1.3 million to pay the tax and estate duty, then the executors may have to sell off assets in the estate. As a financial planner, tax practitioner or accountant, you may want to consider ensuring that estate planning for your clients is done wisely, and this may mean either ensuring that such a property like this is specifically bequeathed to the surviving spouse, or maybe recommending a life policy with enough cover to provide for estate duty and with the surviving spouse as the beneficiary. Note that the 1.3 million does not even include executors' fees, which could easily add a few 100,000 rand extra owed by the estate. It is unfortunately true to say that the last person to get anything out of the estate is the widow.